Everyone, welcome back. Today we are looking at accounting equation, and accounting equation plays an important role in understanding the basic concepts of accounting. Therefore, if you want to be a very good accountant, it is important that you pay attention and understand what an accounting equation is. So what then is an accounting equation? Accounting equation summarizes the essential nature of double entry system of accounting, and it can be represented as assets equals to liabilities plus owner's equity. Owner's equity. So assets is equal to liabilities plus owner's equity. Now, this is an equation, and an equation has the left side and the right side because you are equating two different elements. Two different elements. So the assets is on a side in accounting we call the debit side. So this is the debit side, and the liabilities and the owner's equity is on the credit side. It's on the credit side. You see, on the credit side. So in an accounting equation, the rule is that the debit side should always be equal to the credit side. It has to be equal. Now, an example, if the total asset is 50,000, it has to be equal with the liabilities and owner's equity. So 50,000. So your liabilities can be 15,000 here plus your owner's equity. The difference is 35,000. So when we add both, we get 50,000 here, which is equal to the total assets of 50,000. 50,000. Okay, so that is the basic rule in accounting equation. And also, we can rearrange the accounting equation in various forms. So let me represent A. Let me use assets, A to represent assets, and use L to represent liabilities. So I would like to use C to represent owner's equity, also known as capital. Capital. So C to represent owner's equity. Now, so we can rearrange it just as in equations in mathematics. We can do change of subject. So we can make liability the subject and make it assets minus capital. It's the same thing, just like change of subject in mathematics. So liabilities is equal to assets minus capital. We can also make capital or owner's equity the subject and make it capital is equal to assets minus liability. Now, before we pick examples to demonstrate the accounting equation, I want us to understand what an asset is, what a liability is, and what capital is. So let me move to the next page and let's talk about asset. Let's use some few minutes to discuss what an asset is, because this will help us. If we are able to identify assets, it will help us to pass correct journal entries. So an asset in simple terms is all the property owned by the company, all the properties owned by the company. So any property that is owned by the company is referred to an asset. So if you're a student, you cannot write this in your book. You need to write the proper definition. So you can say that an asset is a present economic resource, economic resource which is controlled. My handwriting. It is controlled by the entity. So the entity in question, controlled by the entity as a result of past events. Then you can add that of which future economic future economic resource or resources are expected to flow into the entity into the entity to the entity. Okay, so a present economic resource, okay, present economic resource, that is the right that the asset has the potential to produce economic benefits. Okay, so if the assets can produce economic benefits to the company, it is termed as an asset. And so it also talks about control. Okay, so control has to do with the ability of the entity to restrict or use the asset. So an example is cash. The entity has the ability to keep the cash in a particular place, let's say in a bank, to deposit it in a bank, to restrict the use of the assets for some time. So that is the type of control we are talking about. And when you look at a balance sheet, a typical balance sheet, you are going to find out that there we have two types of assets. You find non-current assets. Let me write NCA, non-current assets. Okay, so non-current assets are assets that are typically held for periods that extends beyond 1 year. Okay, beyond 1 year. Okay, this is one. Beyond 1 year. So we can have property, plant and equipment, PPE, property, plant and equipment, which will include cars, lands, building, equipment. We can even have software and even long-term investments, like investments in associates, your generators, okay, your power plants, your equipment, all these things will be used for more than 1 year. You have the company can purchase a land, can purchase a building, can purchase any equipment. So if the equipment is intended to be used beyond 1 year, then we record that as a non-current asset. Non-current asset. So number two, we have current assets. Let me make it CA, current asset. So current assets will be used within 1 year. Within 1 year. That is the intention. So if the company or the entity decides to use an asset or is expected to use an asset within a year, it is normally termed as current asset. So we have cash, normal cash, we have cash and cash equivalents. We have inventory. Inventory has to do with stocks. Okay, we have trade receivables. We can have receivables or debtors. Okay, so when the company or the entity makes sales on credit, this is what we call as receivables or debtors. Okay, we can have some short-term deposits. Maybe the company decides to put part of their money in some short-term investments, maybe 3 months treasury bill or 6 months treasury bill. It is also termed as an asset. So generally, an asset has to do with all the properties owned and controlled by the company. So number two, I want us to look at liabilities. Okay, this is part of the credit side of the accounting equation. Okay, so if you're a student, you need this definition that an asset is a present obligation. A present obligation of the entity, present obligation of the entity to transfer an economic resource. So economic resource can be in the form of cash, economic resource as a result of past events. Okay, as a result of past events. So liabilities represents amounts owned by the assets, by the entity. The entity may transact businesses on credit. So when the entity engages into a credit transactions, then it will develop liabilities for the company. So we can, on the balance sheet, you also find non-current assets and non-current liabilities and current liabilities. So you find non-current liabilities and you also find current liabilities on a typical financial statements. So the current liability as these are liabilities that are due to be settled, let's say above 1 year. If it is going to take more than 12 months or a year to pay that particular liability, it is termed as a non-current liability. So this is beyond 1 year, beyond 1 year, beyond 1 year, just like non-current assets. Okay, just like non-current assets. So beyond 1 year. And current assets, these ones are due to be settled within 12 months. Okay, so within 12 months. Within 12 months. So we can have examples of both. Here we can have long-term loans. So we can have bank loans. These ones are long-term. Some of the bank loans have to be settled in 3 years or 4 years, some 5 years or 10 years. So we can have that. We can have bonds. These are all forms of debts and various types of debts. And we have the current liabilities, which is you can have trade payables, trade trade payables. Okay, trade payables. You can have short-term loans, etc. Okay, so any liability that will be settled within 12 months is current liability. It is a current liability. And if it will go beyond a year, it is termed as non-current liabilities. So when you pick a balance sheet and you see non-current, non-current means that it is supposed to be held or settled beyond 1 year. And if it is current, whether current liability or current asset, it has to be settled within 12 months. So now let's talk about equity. Let's look at owner's equity. In other books, you will find capital is the same thing. Capital. You will find the same thing. Okay. So equity. So if you're a student, you need this. So equity is the residual. Okay, we call that the residual interest. Residual interest in the assets of the entity okay, after deducting all of its liabilities. So this refers to the amount of money that the owners contributed into the company. Okay, so when the owners make deposits into the company as a contribution, it is termed as a capital. Now, if the company is to wind up or goes bankrupt, if we are supposed to share the assets, you have to pay all our liabilities first. So the difference, if there's after selling the assets to pay our liabilities, if there's any remaining, that is what we term as the residual. So if there's any remains after paying all our liabilities, that goes to the shareholders, that is the owners of the entity. Now, when you look at the balance sheet, you also see something called retained earnings. So retained earnings Okay, retained earnings. So retained earnings, this is the net profit. Okay, net profit refers to the net profits of a company. That is their revenue minus their expenses. So if the company makes profits and decides to keep some of the profits into the company, it is termed as retained earnings. Retained earnings. So the profit or loss, PL, profit or loss, is the total income made by the entity. The total income made by the entity for the period, less all the expenses. Less all the expenses. Okay, so the net profit, if it is a profit, you see that, or loss, profits will be added to the owner's equity. You will find a place written retained earnings on the balance sheet, and you find it over there. So that is the profits you see over there. Okay, so we know what income is revenue. Okay, and expenses are the running costs. So we have like administrative costs, selling and distribution costs, wages and salaries, advertisement. All these things are examples of expenses. These are the running costs, the costs we incur in running a business. Okay, so now let's try to solve a question. I have a nine. Okay, so now we have a question here. So the first one is let me move this one here. Let's respond. Okay, so it says that commence business with cash 200,000 USD and land of 50,000 USD. Okay, so this is the first question. So we need to set or list the assets and liability. So we need to draw a table before you can actually solve this question, because it helps to organize your work nicely. So it's either you draw the columns, the assets, and you make it big so that you can insert as many columns as it becomes necessary, and your liabilities and capital as well. Okay, so I have gone through the question and I have identified that, okay, this number of columns will help me solve this particular question. So let's start. So the first one says that commences business with cash 200,000 USD and land of 50. Okay, so the the elements in the accounting equation involved is cash and land. Okay, so cash land, that is what the owner is contributing into the company. So we need to write our cash here and put our land here as well. Okay, so question one, it says that cash of 200,000. So cash of 200,000 was introduced into the company, and he also brought a land. So it looks like he's using his land to set up the business. So 50,000. Now our total asset is 250. So we need to credit the other side to ensure that the credit side is equal to the debit side. So here should be owner's equity. Okay, so, and like I explained, the owner equity contains the capital. That is how the amount of money the owners contributed into the company. And there's reserves or retained earnings. Okay, the profit or loss, the net profit or loss is also at the owner's equity. Owner's equity. All right, you find it there. So he has contributed 250,000. That should be his capital. So we have 250,000 here. Okay, so now let's look at the balance. So total assets, that is from here to here, we have 250. Okay, if you have a calculator, you can just confirm that. Then the total liabilities, that is the credit side, that is your liability plus your capital. There's zero dash here, this is dash, so it becomes only 250. So that becomes the balance as at now. Okay, so we are done. Let's go to question 2. Question 2 says that bought merchandising for cash 80,000 USD. Now merchandising is an expense. This is advertisement. Advertisement can be found in your income statement. When your expenses increases, it decreases your net profit. It decreases your net profit, which is the owner's equity, part of the owner's equity. So your you bought merchandising with cash. Okay, so your cash will reduce. So you took some of your cash from here, you reduce it by 80,000. You removed 80,000 from your cash, and you sent it to your advertisement agency. Okay, so your expenses will go up and it will reduce your net profit by 80,000. So you are going to lose 80,000 here. You're going to lose 80,000 here. Okay, so that is it. So let's look at our balance. So now 80,000 minus 250,000 USD. What do we get? Okay, those who are following, can you calculate for us? 250 minus 80,000. Okay, so I had 170. That is the balance, because that is the only transaction. There's nothing here, so there's no liability as well. So 80,000 minus the balance of 250, we are getting 170. Very simple, very simple. Number 3, we are done with this. So cash sales worth 225,000 USD. Cash sales. So we made sales. Okay, so sales has increased by 250, and we sold it and received cash. So right now our cash is increasing by 25,000 USD, and our sales, when sales increases, our net profit also increases. Okay, so it is increasing by 25,000 because our net profit will actually increase. Okay, so now let's look at the balance. So 170 minus 25 minus 25. So the calculators, where are you? 170 minus 25. Okay, are you there? Okay, so we had 145. That is what I had. If you are following, you should be getting the same answers. If not, you can let me know in the comment. I'll correct. So on the debit side, up to here we have 145. So let's go to the credit side. So the credit side, we start from the liability and capital. From the equation, asset is equal to liabilities plus capital. Okay, so on the right side of the equation, we have a balance of 170 minus 25. So you get the same amount. Okay, 145. Very good. So we are done. So question 3, let's go to number 4. Number 4 says bought goods on credit from someone worth 50,000. So we are buying raw materials for the company. So when we buy, we are buying on credit. It says that bought goods on credit. So this will introduce us to liabilities. Okay, when we buy on credit, it is payable. So our payable will increase by 50,000. Okay, so payable is increasing by 50,000. Then when we buy raw materials, it is a running cost. It is an income statement item. Okay, when you are calculating your cost of sales, you have to include purchases of raw materials. You bring your opening stock. If there's no opening stock, you need to add purchases. Okay, so it is going to increase your expenses and reduce your profit. So this becomes an expense. Okay, so it is your expenses are increasing and will reduce your net profit. So it becomes an expense. So we minus it. Okay, we minus it. Okay, so this transaction doesn't affect our assets. Okay, so there's dash here, there's nothing here. So let's calculate our balance. We just bring it down, we just carry it down because this transaction did not affect it. Then when we go to our liabilities, we have a balance of 145,000 USD. Now 50,000 minus 50,000 is 0. Okay, because we are adding this to and then this is negative, this is positive, and it is 0. So 0 plus 145, we are still getting the same thing, and our debit side once again is equal to our credit side. It's the same. So number 5, it says that sales on account to Ali 12,000 USD. So when we sell on account, it means that we sold on credit. We made sales, our sales have increased, all right, but we did not take cash. We did not take cash. We gave him a document that he owes us, which means that he will have to pay in some time, maybe a month, some months later. So this becomes a receivable. Okay, receivable. So let me add it to our asset. Receivable is an asset. If you remember the example that we listed, this is a current asset. This is a receivable. So Ali owes us. Ali is our debtor. So what happened? What happened here? Sales of 12,000. Okay, so our receivables will increase by 12,000, and when we make sales, it is increasing this revenue. Okay, so it is revenue will increase our net profit, so it is increasing. This is revenue, our sales, because the income statement, don't forget this, the income statement operates on the accrual basis. Okay, so as soon as the item is transferred to Ali, we need to recognize that as revenue. Even though he hasn't paid yet, we need to recognize that as revenue, but he will pay later. Okay, so let's look at the balance now. So the balance is the balance here. So we have 145 plus 12,000, because that is the only transaction over here. So 145 plus 12,000, we get 157. 157. Oh, I think we are on a good road. I think I can leave the rest for you to continue, or do you want me to finish? So the same thing applies. So 12,000 plus 145, we are getting the same thing. Very easy as ABCD. Very easy. Okay, let's quickly look at number 6. So we are done here. So number 6 says that purchase furniture of value 5,000 by cash. So furniture is an asset. Furniture is an asset because this is an economic resource, and the company will enjoy when we use the furniture. It's an asset. Okay, so we bought cash. We bought it by cash 5,000. So we removed 5,000 from our coffers. So our cash will reduce by 5,000, and we bought furniture. Now we have a furniture as an asset which is worth 5,000. So this transaction will not affect any of the liabilities or capital. Okay, so our balance, so 5,000, so we are losing 5,000, we are earning 5,000 from the purchase of furniture. Okay, so this plus this is 0. We add it to our balance, you get the same amount. So you can see that it is still the same. It is still the same. There's nothing here, there's nothing here. So you just bring it down. The balance brought down is still the same. That's balanced. Okay, my page is full. Let me go to the next page here. Okay, so I'll have to repeat everything. Okay, let me quickly write down our assets, and you can have liability and equity here. Okay, so I remember we had cash, we had the land, receivable, and we had furniture, and here was payables, and we had honest equity. Okay. So our balance, this will be a balance brought forward. So our balance brought forward, let me copy from the other one. It was 157. So balance brought forward was 157 for the total assets for our liabilities plus equity, okay, it is 157. Okay, so let's go to question 7. This is number 7. So number 7 says that we receive cash from Ali Reza 10,000. We received 10,000 from Ali. If you remember, Ali bought goods worth 12,000 from us here, and he's now paying 10,000. So now Ali is giving us cash. We are receiving cash of 10,000. So our cash will increase by 10,000, and we have to reduce his account, his debtors account, by 10,000. Okay, so that is what is going to happen. So we are receiving cash 10,000. This is number 7. Then we are reducing his account by 10,000, receivables account by 10,000. So once again, this will just cancel each other, and we are going to have the same one. Okay, so nothing happens with the liabilities and the owner's equity. So we will get the same 157,000. Okay, so it is still balancing. Debit side and credit side is the same. So let's take the last but one. So it says return defective furniture of worth 1,500. So the furniture that we bought, we are returning it. So we need to go and give back 1,500 to them, 1,500 to them, 1,500 USD to them. So we are reducing the furniture. We will take that quantity that represents the 1,500 from them, from our office, and send it back to the stores. And when we do that, we are going to receive our money back. They will give us 1,500. Okay, we are going to receive it back because it is defective. So the balance, once again, so when you add the transactions for the assets, it becomes 0, because 1,500 plus minus 1,500 is 0. So we add it to the balance, and we are still getting the same thing. And we have this transaction will not affect any of the equities, whether liabilities or owner's equity. So we are still maintaining the same thing. So you see how lovely and wonderful this is. Very, very smooth and easy to do. It's balancing. So let's pick the last one. The last one says that paid wages 1,000 USD, rent 2,000 USD, and electricity bill payable. Okay, I think there should be an amount here. Let me open. Okay, so electricity bill payable. Okay, I've gone to the other side. It is 2,000. Okay, sorry, I can see it. It's 1,500. Did you see that? Okay, so it means that we use some of our cash. To pay wages. We use 1,000 USD to pay salaries. We use 2,000 for our rent. And electricity, we have enjoyed electricity from the government, 1,000 worth 1,500, but we haven't paid yet. So this becomes payable. This becomes a payable, which means we pay in the future. It is a liability that we are supposed to pay. Okay, so let's add it. So cash item is 1,000 plus 2,000, that is 3,000, that is leaving our coffers, which represents the wages and the rent. And we have a payable of 1,400. Now these are all expenses. So as these are all expenses which will be deducted from our income. Okay, so in your income statement you will find all these expenses over there, and it will reduce your net profit. Okay, so you have to look at the total. Okay, so when it comes to cash item, it is 3,000, which includes wages of 1,000 and rent of 2,000. Okay, so let's put it there. Okay, so our cash, so rent of 1,000, wages of 2,000 becomes 3,000. We are going to pay this amount of money. It's leaving our coffers. Then our liability, the electricity, is a payable. So it is increasing our liability by 1,500. Okay, now total expenses, our total expenses is 4,500, because in your income statement you have to add 2,000 plus 1,000 representing your rent and your wages respectively. Then your liability, your ECG, your electricity of 1,500. If you add the 3, you get 4,500. This will be present in your income statement as expenses, as expenses, as expenses. Okay, so this is it. So let's look at the balance and see if we are going to see the balance between the debit side and the credit side. So 157 here minus 3,000, you get 154, 154,000. Okay, then we go to the other side. So we have 157 as the balance. Then we, okay, this is an expense, sorry, it has to be in bracket. Don't forget, it's an expense, but this reducing, it has to be in bracket. Okay, so we add our payable or liability of electricity of 1,500. Then we take out the total expenses from the income statement, that is 154, 154. So when we add this and this, we get 3,000. Okay, so it becomes 3,000 when we add 1,500 plus minus 4,500, we get 3,000 negative. Then we take it out from the balance here and we get the same 154,000. This is very simple and easy to do. Very simple and easy. Very, very simple. So if there's any question you want to ask, kindly write it in the comment section and let us learn together. Thank you very much. Please subscribe and help share with your friends. You can also comment the topics that you want me to treat, and I'll be very happy to help you on that. See you and have a lovely day. Bye.